Hello and welcome back to the TradeSmart. In this video, we will explore the psychology of losses and drawdowns and how they affect traders' cognition, emotion, and behavior. Let's begin by defining what are losses and drawdowns in trading. A loss is simply the difference between the price at which you buy or sell an asset and the price at which you close your position. A drawdown is the peak-to-trough decline in your trading account value over a specified period of time. For example, if you start with $10,000 in your account and it drops to $8,000 at some point, then you have a 20% drawdown. Losses and drawdowns are inevitable in trading, especially in day trading, where you are exposed to frequent price fluctuations and market noise. No matter how good your trading strategy or system is, you will experience losses and drawdowns at some point. The question is, how do you deal with them? The answer is not so simple, because losses and drawdowns can have a profound impact on your psychology as a trader. They can affect how you think, feel, and act in relation to your trading performance and outcomes. Let's look at each of these aspects in more detail. Let's talk about how losses and drawdowns affect your cognition, or your mental processes of perception, memory, judgment, and decision-making. Losses and drawdowns can distort your cognition in various ways, such as loss aversion. This is the tendency to prefer avoiding losses over acquiring equivalent gains. In other words, losing $100 hurts more than winning $100 feels good. Loss aversion can make you reluctant to take risks or cut losses when necessary, or make you overreact to small losses or fluctuations. Anchoring. This is the tendency to rely too much on the first piece of information that you encounter when making decisions. For example, if you bought a stock at $50, you may anchor your expectations and evaluations to that price, even if the market conditions have changed. Anchoring can make you hold on to losing positions for too long or miss out on profitable opportunities. Hindsight bias. This is the tendency to believe that past events were more predictable or obvious than they actually were. For example, after a market crash, you may think that you should have seen it coming, or that there were clear signs that you ignored. Hindsight bias can make you overestimate your ability to forecast future events, or underestimate the role of luck or randomness in trading. Confirmation bias. This is the tendency to seek out or interpret information that confirms your existing beliefs or hypotheses while ignoring or rejecting information that contradicts them. For example, if you are bullish on a stock, you may focus on positive news or indicators that support your view, while disregarding negative news or indicators that challenge it. Confirmation bias can make you blind to alternative perspectives or scenarios, or make you resistant to change your mind when evidence suggests otherwise. These are just some examples of the cognitive biases and heuristics that can influence your perception and evaluation of losses and drawdowns. There are many more that we will discuss later in the course. The main point is that losses and drawdowns can impair your rationality and objectivity as a trader. Let's talk about how losses and drawdowns affect your behavior, or your actions and reactions that result from your trading experience. Losses and drawdowns can influence your behavior in various ways, such as revenge trading. This is the act of trying to recover one's losses by taking bigger or more aggressive trades, often without regard to one's trading plan or risk management. Revenge trading can be motivated by anger, frustration, or ego. Revenge trading can lead to increased volatility, reduced liquidity, impaired judgment, violated rules, etc. Chasing losses. This is the act of trying to recoup one's losses by taking more or similar trades, often without regard to one's trading plan or risk management. Chasing losses can be motivated by regret, fear, or greed. Chasing losses can lead to increased volatility, reduced liquidity, impaired judgment, violated rules, etc. Risk aversion. This is the act of avoiding or reducing one's exposure to risk or uncertainty, often by taking smaller or fewer trades, or by exiting trades early. Risk aversion can be motivated by fear, anxiety, or loss aversion. Risk aversion can lead to missed opportunities, lower returns, reduced diversification, etc. Risk seeking. This is the act of pursuing or increasing one's exposure to risk or uncertainty, often by taking larger or more trades, or by staying in trades longer. Risk-seeking can be motivated by greed, euphoria, or overconfidence. Risk-seeking can lead to excessive losses, higher volatility, reduced diversification, etc. These are just some examples of the behaviors that can result from losses and drawdowns. There are many more that we will discuss later in the course. The main point is that losses and drawdowns can affect your performance and outcomes as a trader. As you can see, losses and drawdowns can have a significant impact on your psychology as a trader. They can affect how you think, feel, and act in relation to your trading performance and outcomes. However, this does not mean that you are doomed to succumb to these psychological effects. There are ways to cope with them and overcome them. In the next video, we will explore some of the strategies and techniques that can help you deal with losses and drawdowns in a constructive way. We will also discuss how to avoid some of the pitfalls and dangers of revenge trading and chasing losses. We will also learn how to develop resilience and adaptability in the face of losses and drawdowns. I hope you have enjoyed this video and learned something new. In the next video, we will talk about the dangers of revenge trading and chasing losses. Stay tuned for more.